It might be challenging for novices to trade currencies. This is typically caused by the usual yet unjustified expectations of newcomers to this sector. Many fundamental ideas are the same whether discussing stock trading for beginners or FX trading for beginners. We're going to concentrate on Forex trading in this video. However, stock trading also uses some of the same tactics, vocabulary, and overarching ideas. By the end, you'll be familiar with all the key phrases used in Forex trading, ensuring you stay aware of the situation when learning to trade. You'll learn all the fundamentals, including how to execute trades, which trading platform to use, and 10 Forex trading tips for beginners who wish to learn new tactics. Let's start the video with the basic trading terminologies of Forex. Spot currency and real currency is bought and sold while trading Forex. For instance, you could buy a specific pound sterling amount and convert it to euros. Then, when the pound's value rises, you could convert your euros back into pounds and get more money than you did when you first converted. Contract for difference is what the abbreviation CFD means. This contract represents the price movement of financial instruments. In terms of Forex, this implies you may profit from price changes without owning the asset by taking advantage of market swings instead of purchasing and selling large quantities of money. CFDs in stocks, indices, bonds, commodities, and cryptocurrencies are also offered in addition to Forex. In every instance, they let you trade in these instruments' price alterations without purchasing them. Then in currency pairings that are not JPY, a pip is the base unit in the price or 0.0001 of the quoted price. Therefore, when the bid price for the euro against the US dollar pair changes from 1.16667 to 1.16677, it changes by 1 pip. The spread is the price difference between buying and selling a currency pair. The spread is frequently small, sometimes even less than a pip, for the most widely used currency pairings. The spread is typically significantly bigger for pairings that trade less frequently. The value of the currency pair must be greater than the spread for a Forex deal to be profitable. The items to think about before placing a transaction are covered in the next portion of this Forex trading for beginners video. Before you place a trade, you must choose whether to go long or short, how much it will cost you, and the size of the spread. You may choose which trade to enter by being aware of these variables. We go into further depth on each of these topics below. In a long trade, buying a currency with the hope that it will appreciate allows you to benefit from the price difference between the buy and sell. And in a short trade, you sell a currency in anticipation of a decline in value so that you may purchase it back at a cheaper price and profit from the difference. The exchange rate used to determine the price at which a currency pair trades is the quantity of the second currency you would get in exchange for 1 unit of the first currency. How much can a given currency be expected to vary, therefore, since the way brokers earn money is by collecting the difference between the buy and sell prices of the currency pairs. This relies on the currency's liquidity, or how much is purchased and sold simultaneously. The currency pairings with the greatest supply and demand on the Forex market are the most liquid. The most liquid currency pairings are often the big ones, with the euro against the US dollar pair moving 90 to 120 pip on average every day and offering the most opportunity for day trading. The US dollar against the Hong Kong dollar pair merely fluctuates at an average rate of 32 pip per day, while the Australian dollar to the New Zealand dollar pair swings between 50 and 60 pip per day. The most liquid Forex pairings are often the major ones. However, if you have any special expertise about a certain currency, there are also lots of chances between small and exotic currencies. Without mentioning charts, this video would not be complete. Traders using the MetaTrader platform have the choice of 3 distinct types of live Forex charts when monitoring the exchange rate: line charts, bar charts, or candlestick charts. The most basic type of chart used by traders is a line chart, which connects the closing prices of the time frame you are viewing. For example, when viewing a daily chart, the line connects the closing price of each trading day. Unlike some of the other chart types, it is primarily used to identify larger-scale trends, but does not offer much else. A bar for each time the trader is observing is displayed on an OHLC bar chart. Therefore, each vertical bar on a daily chart corresponds to 1 trading day. The bar chart is distinctive because it provides many more features than a line chart, such as the bar's open, high, low, and close OHLC values. The opening price is shown by the dash on the left, and the closing price is indicated by the dash on the right. The market's highest price transacted during the chosen time is represented by the bar's high. The market's lowest price transacted during the chosen time is represented by the bar's low. Because the closing price is higher than the starting price, the green bars are referred to as buyer bars. Because the closing price is less than the beginning price, the red bars are referred to as seller bars. The first users of candlestick charts were Japanese rice dealers in the 18th century. The fact that they also provide the open, high, low, and close values for a certain time makes them comparable to OHLC bars. Candlestick charts, on the other hand, contain a box separating the open and closed price values. This is sometimes referred to as the candlestick's body. When watching real-time Forex charts, many traders find candlestick charts to be the most aesthetically pleasing. They are also incredibly well-liked since they provide traders all across the world access to a wide range of price action patterns. Selecting one of the top Forex trading systems for beginners is the next step in our guide to Forex trading for beginners, now that you know how to get started. Fortunately, a large variety of Forex trading tactics are already available because banks, firms, investors, and speculators have been trading in the markets for decades. This is a useful component to include in your notes for Forex trading because you might not recall them all after your initial reading. These systems include the following. Currency scalping. A kind of trading called currency scalping involves buying and selling currency pairings in incredibly brief time frames, often between a few seconds and a few hours. This is a highly practical method that entails creating several little gains in the anticipation that they will add up. Intraday trades. Intraday Forex trading is a more cautious strategy that may be suitable for novices. The 4 or 1 hour price patterns are the main emphasis. Trades may be available for 1 to 4 hours. Generally speaking, they concentrate on each Forex market's primary sessions. As a Forex trader, there are many hazards that you should be aware of. Risk associated with leverage. Leverage in trading might affect your trading results favorably or unfavorably. Your gains or losses will be greater with a higher level of leverage. Interest rate risk. If the interest rate of a nation increases, the currency may appreciate. The increase in strength can be linked to a surge in investments in that nation's money markets since better returns are possible with a stronger currency. The timing discrepancies between the various nations may be a factor in the exchange rate risk, known as transaction risk. It may happen at any point during the course of a contract. We have tried our best to make you learn all the basics about Forex trading because it is hard to earn money and easy to waste it on things that you are not properly trained with. The last thing before ending the video, do not forget to subscribe to the channel Trading Access.